All right, welcome. Have you ever thought about how your travel plans could actually have a huge impact on your wallet? Well, we're going to dive into a really fascinating tax puzzle today. How the number of days you spend in India, and not your passport, can decide what taxes you owe.
So, let's make this real. Just imagine this for a second. You're an Indian citizen, you're living and working abroad, maybe somewhere like Dubai, but you still got investments or a property back in Mumbai. Are you on the hook for Indian taxes? The answer? Well, it might not be what you think, and it all boils down to one single crucial concept.
And this right here is the heart of the matter. See, India's Income Tax Act doesn't really care that much about your passport or your citizenship. The one thing that truly matters is something called your residential status. And if you get this one idea, you've basically cracked the code.
So what exactly is this residential status? Well, think of it like a label you get every single financial year, and it's based on a really simple countdown. How many days were you physically in India? This is super important. It's not a one-and-done thing. Your status can literally change from year to year, all depending on your travel schedule.
Okay, so let's get into the nitty-gritty. How do you get this resident label? Well, you just have to pass one of two tests. Either one will do. Condition 1 is super straightforward. You were in India for 182 days or more during the financial year. Simple. Condition 2 has two parts. You were in India for at least 60 days in the current year, and you were there for a total of 365 days over the 4 years right before that. Pass either test 1 or test 2, and you're a resident. All right, so rules are one thing, right? But a story, that's what really makes it all click. So let's bring in a real-world example from our source material. Let's talk about Brett Lee, the famous Australian cricketer. He's in and out of India all the time. How would these rules apply to him?
Okay, let's say in this financial year, Brett Lee spends 100 days in India. Now that's less than 182, so he fails condition 1. No problem. But it is more than the 60-day minimum for condition 2. So what does that mean? It means we have to check the second part of that rule.
And what about his recent history? Well, it turns out in the 4 years just before this one, his total stay in India was 400 days. Remember the magic number for that second part? It was 365. He's way over that.
So there you have it. More than 60 days this year and more than 365 in the previous 4. He passed condition 2 with flying colors. And boom, that makes Brett Lee a resident of India for tax purposes, even though he's an Australian citizen.
But wait a minute. Just when you think you figured it out, there's another layer to this onion. Just being a resident isn't the end of the road. There's this subcategory that really fine-tunes things, and it determines exactly how much of your income gets taxed. So we have to ask the next question. Is he what's called a resident and ordinarily resident, or for short, an ROR?
Okay, so this brings in a new test. The rule is, to be an ordinarily resident, you need to have been in India for at least 730 days over the last 7 years. So we look at Brett Lee's total, and it comes out to 700 days. So close, but not quite there.
And because he just misses that 730-day mark, he falls into this really interesting special category, resident but not ordinarily resident, or RNOR. Think of it as a middle ground, a status for residents who haven't spent quite as much time in the country long term. And as we're about to see, this RNOR status makes a huge difference.
You know, tax law is never simple, is it? It's always full of exceptions and special cases. So let's look at a really important one. Let's meet Anand. He's an Indian citizen, and he's part of the crew on an international ship. For a guy like him, the rules we just went through, they change a lot.
This is a fantastic example of how some jobs get their own set of rules. For seafarers like Anand, that whole 60-day condition, you can just throw it out the window. It doesn't apply. Only the 182-day rule matters. And here's the real kicker. The days he's officially on his voyage, from the moment he signs on the ship to the moment he signs off, those days don't count as days in India. So when you do the math for Anand, his time in India is just 178 days. And since that's under 182, his final status is non-resident.
So you might be thinking, okay, ROR, RNOR, non-resident, why do all these labels matter so much? Well, this right here is the whole reason we do this. Because once you know someone's status, that's when you can finally figure out which parts of their income are actually taxable in India.
But before we get to the big chart, let's just quickly nail down what Indian income even means.
It's basically what it sounds like. Any money that has a strong connection to India. We're talking about things like salary for a job you did in India, rent from your flat in Mumbai, profit you made selling shares of an Indian company, or interest from your Indian bank account. Pretty intuitive, right?
All right, and here it is. This is the slide that puts it all together. This is the payoff. First thing to notice, see that top row for Indian income? Everyone pays tax on that. ROR, RNOR, non-resident, doesn't matter. If it's Indian income, it's taxed in India. Simple. But look at what happens with foreign income. This is where everything changes. A non-resident like Anand the seafarer pays 0 tax on it. An RNOR like Brett Lee only pays tax on foreign income from a business that's controlled from India. And the ROR, well, they pay tax on everything. All of it.
And if you want it straight from the horse's mouth, check out this quote from the Income Tax Act itself. What does that mean in plain English? If you are a resident, an ordinarily resident, an ROR, India has the right to tax your entire global income. It doesn't matter where in the world you earned it. This is a massive, massive difference, and it's why figuring out your status is so incredibly important.
So after all that, all the rules, the exceptions, the different acronyms, what's the one thing you really need to remember? It's actually beautifully simple. The number of days you are physically in India, that's the key. That number decides your status, and your status unlocks exactly what your tax liability is going to be.
And that leaves us with one last thing to chew on. In a world where you could work from anywhere, with remote work and digital nomads becoming so common, does it still make sense for the most important tax factor to be how many days your feet are physically on the ground in one country? It's a huge question, right? And it's one the tax laws all over the world are struggling to keep up with. Definitely something to think about.